Hey everyone, I thought I should introduce myself before I get started on this embezzlement project. My name is Jacob DeLeon. Currently I work full-time at Verizon Wireless as a solution specialist while going full-time to KCC in order to get my prerequisites in order to go to the Schuyler College of Business. This accounting class is one of those prerequisites, so let's get started with this embezzlement project. Before I really get started in kind of explaining how this embezzlement went, I wanted to kind of explain some of the terminology and how the business operated in order to kind of make it a little bit easier to follow some of the stuff that happened. So the company that we're studying is called Peregrine Financials, and what they were they were a futures commissions merchant that was specialized in pioneering online trading. Um, similar to E-Trade and all this other stuff. They specialize in selling futures, and what they would do is they would sell these contracts and take fees for selling these contracts. One of the important parts about this is customers would put their money into a segregated account under the company, and the company would use that as a holding for when they would purchase these contracts. The company makes their money off of the fees, and they can't touch the segregated accounts. That's very illegal and not allowed. Some of the external regulators, one of them being the CFTC, or the Commodity Futures Trading Commission, basically make sure that these businesses stay in line by checking with them and making sure that they're within regulations. With knowing this, we can actually get started on the case. So this case was a little bit more difficult because it was actually the CEO of Peregrine Financial, Russell R. Wassendorf Sr., that was actually embezzling the money from the company. He embezzled $200 million from segregated accounts over the span of 20 years. This is one of the longest running spans of embezzlement that I've ever read about. He actually did this in Chicago, Illinois, and Cedar Falls, Iowa. Cedar Falls, Iowa is where he ended up buying a new business location and transferring all of his stuff there. The reason why he ended up doing this embezzlement was actually, at first, there were regulations input by the CFTC that made it so that his financial firm had to have a certain capital threshold. When he dropped below it, he ended up embezzling money from the segregated accounts in order to keep his business afloat instead of having it collapse. Then once I guess he realized that he was able to get away with it, greed consumed him. So how Russell got away with this is actually pretty unbelievable. The first part is he ordered that all bank statements be delivered to him unopened to his office, became the only person that had access to the bank's online portal, and told the bank that he was the only one they should interface with for the PFG accounts, essentially closing off every avenue that someone else would be able to look at what he was doing, and restricting it all to himself. After that, when he would withdraw money from the segregated accounts, he would forge the bank statements after receiving them to say that they had the original balance that the company was going to provide, and then gave those forged documents to the accountants. After a while, it became a common practice for certified auditors and field auditors to mail balance confirmation forms directly to the bank to make sure that the bank statements at the bank matched the statements that the business were saying were located inside the segregated accounts. And what he did was he intercepted those forms and created a forged document that showed the return address for the bank being the P.O. box that he owned. Once the confirmation forms and the bank statements were going to the same P.O. box, it was just a matter of him intercepting everything, changing the numbers to what he wanted them to be, and then forge a bank officer's signature and then send it back to whatever external auditors were auditing him at the time. when auditors actually came to his business, they were not necessarily looking for fraud. They're more looking for little breaks in code and relying on the bank balance confirmations to detect shortfalls in the cash balance. As you can see, a lot of this means that everybody was leaning on the bank balance statements in order to make sure that no fraud was happening. So heavily so that once that was the one thing that was being forged, he was pretty much able to get away with it. So a series of internal control violations that the company committed was a violation of establishment of responsibility. This was violated due to the fact that Wassendorf used his position to block out anyone from seeing the statements coming from the bank. No one else had responsibility of making sure that the segregated account statements were accurate. Segregation of duties was also violated. Wassendorf, on top of having complete access to the bank, was able to forge checks in customers' names and forge bank statements. Since none of these jobs were segregated, he had full reign to do what he wanted, and no one was there to check to make sure that he wasn't embezzling money from the company. Documentation procedures were not followed as the accountants did not suspect Wassendorf of fraud, so they didn't really check to make sure that the documents were original or had any idea that the bank statements were forged. Independent internal verification. This involves review, comparison, and reconciliation of data prepared by employees. This should be made periodically and by surprise. This was wholeheartedly ignored as no one was independently able to check the segregated accounts, since Wassendorf had already closed off all access to the bank statements and the bank. This would make it so that even if they hired someone independent, it would literally take all the bite out of what they had. These are some policies that could have been implemented to prevent this from happening. Of course, if Wassendorf had a partner or someone by his side, this would have been a lot easier to implement. Such as documentation procedures, like to have 2 employees sign for all checks. The original documentation should be looked over well for watercolors or signs that they are not the originals. Segregation of responsibility would make it so that 2 employees should look over the bank statements when received, such as the owner and the bookkeeper, at the same time. An establishment of responsibility puts someone in charge of maintaining the segregated accounts, like to call the bank once in a while to make sure that the statements match what the business says. Wassendorf was actually caught due to improved technology that allowed the CFTC to digitally link the business records and bank records to verify the shortfalls in cash balances. Wassendorf, knowing that he could no longer forge digital links to the banks, attempted to postpone the audit for as long as he could. He eventually found himself painted into a corner and attempted suicide, and wrote a goodbye note confessing to his crimes of embezzlement over the span of 20 years. He was rescued by police, who found the letter and was later prosecuted and given a 50-year jail sentence. With that being said, it's kind of hard to prevent a CEO from embezzling money from his clients when no one is out there to watch him, and that's what you kind of depend on these external regulatory committees or really stubborn accountants to kind of keep the CEO in line. But with that being said, you probably wouldn't be able to keep all embezzlement and fraud from happening. And I think this quote from Alan Greenspan, who was the chairman of the Federal Reserve during the 2008 financial crisis, kind of captures that idea the best. And what it is it's corruption, embezzlement, fraud. These are all characteristics which exist everywhere. It is regrettably the way human nature functions. Whether we like it or not, what successful economies do is keep it to a minimum. No one has ever eliminated any of that stuff. So with that being said, just be diligent and always cautious.